From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, March 20th, and I tell you, after a week like this, it's a week we haven't seen quite like this since 2008 during the global financial crisis. Like, we should all be just happy we made it to Friday, and now we just need to make it through Friday. The markets whipsawed with 1,000 point swings isn't enough. We now have become somewhat accustomed to 2,000 point swings in the Dow, and 10% moves in all the equity markets. So pretty amazing. Breathtaking also is the speed at which the Federal Reserve has begun to utilize its resources in order to support the proper functioning of markets, to prevent what is clearly going to be a sudden stop, is in fact already a sudden stop economic crisis, and trying to keep it from becoming a financial crisis. So the Fed pulled out lots of its tools off its shelf, taking rates down to zero and trying to provide liquidity to troubled markets. We're going to talk a little bit about what the Fed has done this week, and other central banks, and the implications of that. We have our good friend Matt Del Orfano with us today as well. Matt is a senior analyst focusing on technology and special situations globally. In addition to covering specific companies and industries, he focuses on data-driven financial analysis, and we're lucky to have him today taking a look at companies and regions and some correlations and the stresses that we're seeing in those areas. And then we're going to talk about the fiscal response, which I feel like we've been talking about a couple of weeks here about what the U.S. government needs to do on the fiscal side to come in and support the economy, but has still been pretty late in getting done. But we need to see it. So why don't we start with the Fed guys, John and Brendan? We're back to the alphabet soup of the global financial crisis of programs. What struck you as the most useful action by the Fed? And it takes us, I think, all the way back to Sunday night, right?
Yeah, that's right, Tony. Thanks. It was really the cumulative effects, I think, more than any one program in particular, although quantitative easing always tends to be kind of the star of the show. When the Fed came out on Sunday night with their emergency 100 basis point rate cut, which took, as you said, the rates down to the zero lower bound, and announced a $700 billion quantitative easing program. So quantitative easing is asset purchases, so that's expansion of the balance sheet. The asset mix was treasuries, mostly treasuries, but with some mortgage-backed securities as well. And there were also rolled into that a variety of different liquidity provision measures. But then through the course of the week, but the Fed wasn't done. But wait, there's more. Through the course of the week, the Fed announced liquidity support facilities for commercial paper, for primary dealers, and for money market mutual funds. And so these successive rollouts of massive injections of liquidity and a front loading of these of the asset purchase programs. I think the tally of today's Fed purchases are, I think they're an unprecedented 107 billion, I guess that was the number that I saw in asset purchases today alone, which takes the total up to 307 billion this week, which dwarfs about double what they did in the biggest week in the global financial crisis. So the global financial crisis obviously unfolded over a longer period of time, and the Fed has to compress all of these efforts into a really short period, and they've been doing it in a way that, initially when they did it on Sunday night, there was a sense on Monday that markets weren't reacting in the way that the Fed might have hoped. We obviously saw a huge decline in equities and continued stresses, but the Fed obviously kept at it throughout the course of the week. They got some covering fire from the European Central Bank, who came in big on Wednesday night after there were some real dislocations in their sovereign bond markets, and with basically a very similar kind of sized program. And ECB President Lagarde echoing her predecessor, Mario Draghi, when she said, she said no limits, sort of hearkening back to his whatever it takes in 2012, which helped quell the EU debt crisis at that time. Other global central banks weighed in this week as well. Pretty much anyone you could name: the Bank of England, the Bank of Japan, the Reserve Bank of Australia, and so it was really this combined all hands on deck effort for global central banks, which eventually it seems, you don't want to wave any mission accomplished banners at this point, certainly. But in terms of the acute liquidity stresses, they're still very evident. There's a lot of evidence of strain in the system, but at least right now we're seeing some signs of some tentative improvement, and this hopefully getting through this acute phase of the liquidity crisis. There are certainly, down the road, the slower moving but certainly intensifying solvency crisis is. But
John,
and that's not for the Fed alone.
That's exactly the most important point I think people could take from this week is the headlines on the news and everything is about the equity market, but the equity market doesn't really matter. It's a small market. What matters is the fixed income market. And all these measures the Fed and other central banks did was to address the illiquidity in the fixed income and credit markets. That's how companies borrow. That's how people get their paychecks. So while these measures didn't really make the headlines, what they did is all that matters this week. So that's what we should be focusing on. And it wasn't to try to make equities go up. It was trying to make sure that companies can borrow and funds can flow between companies.
Yeah, the areas that they've tried to most directly address is talked about primary dealers, the cash markets, corporate paper, money market, anything that's financing short-term borrowing by companies who, up until a week ago, were going concerns, and we presume in the other end of the tunnel, whether it's 2 months from now, 3 months from now, are going to be going concerns coming out the other end, right? The point is, can we finance them to stay healthy, maintain employment? They're going to go through enormous cost reductions over this period of time in terms of not producing anything, but you don't want them to become unattached with their employees and have the ability to come back once orders are lifted for the return of economic activity. Where are the areas that still need to be done? I'll tell you one area that they've tried to address, but it's still under a lot of stress, is the global dollar market. Dollar swaps, the huge demand for dollars across the globe, which they've tried to do with swaps with major foreign central banks. The municipal bond market is still something out there that we don't know. We don't know how much strain there is. At least I haven't taken a look at it. I don't know if you guys have.
Yeah, the muni market is definitely in a dislocation. And also the muni market is something that the ETF market has you can buy a lot of ETF muni debt. So that is something that the Fed, I know, is spending, is laser focused on and trying to address how we can. There's basically no bid.
What do you think they have to do? What's
the
solution? Just buy munis.
Just buy munis, and I think there's some time considerations there. One thing we look at on a regular basis is the ETFs that Brendan just mentioned. Many of them are trading at a 7 to 10% discount to the net asset value. So there's a bunch of bonds that have real marks in them, even poor market conditions. The fund itself is a bunch of those bonds is still trading 10% cheaper than if you were to buy them together. So that's showing a lot of stress in the liquidity, in the sense the ETF is more liquid than the bonds themselves. That has started to calm down in the last couple days with these funding measures. So that's one indicator that says, but we are still at a stress point. Much of that stress is around the liquidity. So just getting that back in there is going to make a big difference, and we can watch it over the next week.
That's a great point. And it's also a great way to monitor how dislocated the market is.
It's probably a little oversimplified, but it gets the point across on the liquidity.
Right, because once you get liquidity, the market will arbitrage that gap.
Correct.
Tony, you mentioned the dollar. Obviously, we've seen a huge spike in the dollar. That had been kind of the dollar had been kind of lying in the weeds for a couple of weeks as this crisis unfolded. And then really this week is when it took off. And as you mentioned, the overseas dollar, basically dollar liquidity crunch overseas was something that the Fed took note of. Clearly they've been playing whack-a-mole, so to speak. They've been going from addressing the most acute crises and the most acute aspects, and the dollar really began to get pretty wild and rampant to the upside. That increase of the swap lines is good, and we've seen some easing in the dollar basis markets in euro, yen, that sort of stuff, and the dollar's coming off its multi-year highs now.
Do you think they need to do more there? I mean, is there much more they can do there in terms of swaps, or is it something that we think will recede given what they've done already?
Well, I think that increasing the swap lines now, they've expanded the number of central banks that they're doing swaps with, basically upping the totals. I think is probably the next step across the board, and then you get a situation in which the administration has, again, obviously this is their priority lists here, and the administration might start talking about the dollar and doing some jawboning, which we've seen the Trump administration do before.
All right, guys. Hey, I want to get into some things with Matt. Matt, we're going to take a break here, and I'm going to come back and talk about a whole range of sectors and regions, and also ask you something about that. The former Federal Reserve Governor Kevin Warsh was on CNBC this morning, and he talked about the need for the Fed to go in and with Treasury find a way to go in and actually start financing equity purchases and supporting banks to go out and finance companies. And I want to get some of your thoughts on that too. So we'll come back after this. You're listening to the HPS Macrocast.
Every 2 weeks, HPS measures U.S. adults' feelings and expectations for the economy. The HPS Civic Science Economic Sentiment Index accurately measures movements in overall national economic sentiment and provides a more sophisticated alternative to existing economic sentiment indices. To learn more, contact us through HamiltonPlaceStrategies.com.
All right, we're back on the Macrocast. I don't think I said at the beginning of the show, like everybody else, we're remote. We at HPS have been remote for a couple weeks now. I'm in the hills of Western Pennsylvania. John and Brendan, where are you guys?
DC.
Both in DC?
Which is a ghost town. The roads are empty. People are really taking heed to this and doing a good job.
And Matt, where are you?
I'm in Connecticut, and we're the same way. I live right near the train where folks commute into the city, and there isn't a single car in the parking lot that normally has a 5-year waiting list for a parking pass.
Amazing. I'm glad we're all able to get together and actually keep doing the Macrocast because there's certainly, no matter where we are, there's no shortage of things to talk about.
Yeah, we might have to do it every day now.
Yeah, we might have to. There's definitely enough material, that's for sure. Matt, take us. There's so many headlines out there. We're hearing from lots of companies individually. We're hearing from sector leaders, industry leaders about what they're seeing and what their needs are. Could you walk us through some of this and make sense of it for us?
Sure. So I again, like Tony said, there's a lot of headlines out there. I think what we're spending a lot of time on is trying to understand what's actually going on in the street, foot traffic, how much people are spending, and luckily our friends over at Earnest Research have provided us access to a tremendous amount of data, which lets us see real-time consumer spending. So I'll go through some of those points. And HPS and the guys over at MPP have access to this for any further questions if there's interest. So a couple things that we have some data on how much people are spending on their credit cards, and what's really great about that is it lets us actually see what's going on in industries. And we have data through last week, so it's very current. Some of the things that are noticeable are the changes in general merchandise, so that's the Costco's of the world, and everyone's seen the headlines there. what's going on in restaurants, what's going on in department stores, and what's going on in travel. And this stuff is great because it gives a lot of context to what we're seeing in terms of the bailout packages that are being discussed. And so what's fascinating is in the last week, we have seen travel come off 25%, and that's people's actual spending on where they're traveling. That number is increasing to the downside. Department stores are down 10%. Restaurants were flat, but they're now headed down. And we've seen grocers that normally do no growth, right? People don't buy more groceries on every year than they normally do. So it's normally a flat growth industry is doing up 12s.
Yeah, because it was really just this week that nationally we shut down the restaurants, right?
Yeah. And I'll give you another cool piece of data. What's really interesting is if you break out all those spending trends I just discussed, and you look at where they started to change first. So let's take the grocery store spending because it's an indicator of sort of how panicked people are and how much people are paying attention to it. If you look at the grocery store spending in the week from March 5th to the 11th, what we see is that D.C., Connecticut, New Jersey, and New York are all up between 18 and 20%. If you then look down at Virginia, which is around D.C., and Washington State, those are up 13%. And if you look at California, Texas, and Florida, they're up 8 to 11%. So you can actually watch the sort of panic going through the country and where people are paying attention to it and where they're not. This gives some indicators of where people have started to separate. So when we look at the districts that are most affected, it gives us some perspective. So one cool thing we did to understand, and I'm going to bring this back for everyone on what it means for the companies. We are seeing numbers with airlines down 30%, cruise lines down 50%, hotels and online travel agencies down 25 or 30%. So what does that mean? Well, if you have a business that has a bunch of employees and a bunch of fixed costs, those costs don't go away just because your top line goes away. So when we see folks actually, with the government stepping in for airlines, the reality is that Delta came out and said, hey, we had $2 billion less of revenue this month than we did last month. United came out and said we have $1.5 billion less. So all of that means that they immediately start burning cash. And so that can be a very big issue in order for the sustainability of the businesses. So when we look at the current proposals that are out there, I think the government's doing a thoughtful thing in allowing for those loans. I know that there's been some discussion over the last week and again this morning on actually extending equity to companies. And I'm very pleased to see the small business loans become available to people. Because when we look at our data, again, you look at restaurant data, these are small merchants. These are people that are directly affected, right? And so if we can see that they're flat when they're normally up and on their way down, that's a big issue because you have the immediate layoffs and you have the inability to sort of pay your landlord. So when we look at we're very pleased to see the funding efforts around working capital. So that means, can I get a loan to pay my landlord? Can I get a loan to pay my salaries of my employees? Having the SBA be available for that, I personally think it's an opportunity to inject working capital, which is similar to someone writing you an equity check or similar to the restaurant owner having a savings account. So some of these measures I think will have a little delay, but are well targeted.
Yeah, and it's important, like the old adage: if you can't pay a small loan to the bank, you have a big problem. If you can't pay a big loan to the bank has a big problem.
Right.
So all these big companies, they're going bankrupt. Maybe we should support them or not, but there's solutions for that. That happens all the time. The capital markets can fix that in the end. But small and medium-sized businesses don't have that opportunity. So what Germany's done is basically the government has, not basically, they have. They're guaranteeing every loan from if you took a loan from a German bank, the government's guaranteeing it. And I think we have to do that kind of measure because in the end, the pizza shop around the corner is still a really good pizza shop. And when I'm able to leave my house, I'm going to go there. But it might not be for 3 months. So it makes no sense to evict the guy because he can't pay his rent for 3 months. So we need essentially bridge loans to get us there. And the only one who has the biggest pocketbook to write a bridge loan is the U.S. government.
Yeah, the hard part for some of these things, right, is you're right. Like, so government definitely has to come in and do this. It's hard, and we don't have the time to sort through fairness on some of this
at
stuff,
all.
right? No. Right, not at all. So
we can figure that out in a year.
Yeah. So right, and so like we have to think about like what these things are in the future, because you're right. So like we know like the government's going to come in and pay employees essentially. Government's going to come in with bridge loans in order to pay the whoever owns that property. But so the property owner gets paid, and the property owner doesn't appear to be right. That's the only one who gets made whole in all of
right.
this.
Exactly.
And,
yeah.
Right. It's like
because the barber still loses 3 months of haircuts.
Yeah. There's nobody on nobody on that side is saying, hey, I'm gonna put off your rent payment. And, But we need to see. We may need to see those kinds of things happen as well.
Well,
and
especially because most commercial real estate are big companies. Well, they can afford to take a haircut.
So we're already seeing in the markets, we're already seeing commercial real estate mortgages. So stuff that for example, just like people have a loan they have to refinance on their house after 10 years, commercial real estate has something very similar. So this week we've been inundated with calls with folks who have loans that need to be refinanced, and the banks have said, whoa, we don't know what your rent roll looks like. So how are we going to finance you? And I'll give you some examples. There's New York City. Of course, the rents are egregious. You have businesses there that have, let's say you're a restaurant. Each table in your restaurant has to earn $1,000 a night with 3 sittings in order to break even on your lease. So we've now seen several instances of major restaurant owners just say, nope, the business is yours. I'm not paying you my $250,000 lease. So the landlords are going to bear some of that impact, but making sure that doesn't get to the small shopping centers, that's the important part with giving these working capital loans. If they're loans, the moral hazard is generally reduced, but people really do need the capital because you're just not prepared for this kind of volatility.
Yeah, and actually I was thinking about it yesterday. It could be a situation that's similar to when the mortgage borrower realized they could just walk away from their loan.
Correct.
So if everybody walks away from their rent, on the commercial side, the legal system is going to be so gummed up for a decade dealing with it all. You're just going to have to write it off. I do think there will be a realization on the borrower's part that you can just not pay it, and the guy's going to let you back in 3 months.
People are going to. Sorry.
Yeah. Hey, Matt, can I ask you a question? I mean, there was I think it was the CEO of, it might have been Darden Restaurants. It might have been another restaurant chain, large restaurant chain. In fact, I just saw Danny Meyer on earlier today talking about, him, I think he laid off something like 2,000. Yeah. But I think that again, the CEO who I heard was making a case for restaurants in that the ramp up to get back into business for a restaurant is much longer than so many other businesses. He's comparing it to
interesting. Yeah.
Yeah, it's comparing it to movie theaters where, movie theaters, you basically, turn the lights back on, open the doors, and start selling tickets, and people come in and sit, and you spin the movie, and you can start making money again on day one. Restaurants, the workers go away. They do whatever they do. Maybe someone get hired by Amazon for a little while, or Walmart, who's out hiring, and some of the delivery services.
Amazon needs 100,000 people to meet the demand.
Yeah, so it's really hard and takes time. Is that something that's factoring into your thinking when you look at some of these chains that are that need to get back up and running?
Absolutely. So look, when you brought up Darden, they're known to be one of the best managed restaurant companies out there. They're very thoughtful. They came out, they drew their revolver down, they brought in some cash, they cut their dividend, and that allowed them to bring in cash just so they have enough to be able to handle what going through the burn, because they're going to want to keep their employees. So these guys close their units. That's 40 or 50 million a week. that they're burning. I mean, it's a tremendous amount. So they're sitting here and doing the math, and they're saying, hey, I have 20 to 25 weeks of cash. Literally, they drew all their lines, cut their dividend, and they still only have 20 weeks. And this is a major, well-managed company. So when we think about how quickly we need to be able to get the money in the system to avoid people's permanent job losses, the answer is quick.
Yeah.
Like, if we have big claims numbers these coming weeks, and some of the estimates are 1 million, some are 3 million, and we have that for the next 5 weeks, you're going to have a situation where there's a lot of people out there, but if they can go back quickly and they're still in the labor force, it will recover very quickly.
Yeah, and I think claims is a really important point, because we're probably going to have 2 to 3 million people that filed this week. We'll find it out next week. But we're viewing that as a bad thing, but people are forgetting that we have this system, the unemployment insurance, that you pay in your check, and you receive a check with that. But one thing I've been reading about, so everybody that's unemployed, it's not like you're not getting paid. You will get unemployment checks. One thing I've been reading, especially with the hotels, they put their people on furlough so they can keep their health insurance. But if you're on furlough, you're not eligible to file for unemployment. So that's something I think policymakers need to fix, like today. So that 3 million number might be understating the demand. It could be as much as 5 million. Yeah.
Correct. No, look, like I said, I think Tony brought up the issue of timing, right? And that's what we're talking about. So again, when we look at the earnest credit card data, we're seeing that this action is spreading to the Midwest, to Texas, et cetera, where it was mostly on the East and West Coast, and even the West Coast was behind, frankly. So as we think about that, making sure that we get the capital into these small businesses to avoid permanent job losses, i.e. the restaurant shuts down and they can't hire the people back, right, is extremely important. As we see that start to come through, we will see the rest of the economy generally be okay. And what do I mean by that? That's not a prediction. When we look at data in China. China shut down for 6 weeks. Everyone knows it, well understood. We're now seeing postal volumes are coming back to normal levels and showing some growth. We're seeing search traffic come back on the shopping websites. We're seeing delivery services start back up. Now, there's a million supply chain issues. The demand has gone down from Europe, etc., the U.S., because we're shut down. But we actually can see a path to this recovery when the government says, stop, and I'm going to inject into businesses where I need to inject, and then we're going to come out of this on the other end. So we're already seeing that.
Yeah. Well, I think we're going to have a lot more to see too. We're going to learn a lot more, I think, over the coming week, and just seeing how some of these sectors are doing. Matt, stay with us. We're going to come back after this break and talk a little bit more about what we started to talk about in this segment on some of the fiscal response and just what we're seeing out there that in terms of the composition of this package. And then a big question for you guys, I have my view on this as to whether it's enough. So let's come back after this break. You're listening to the HPS Macrocast.
Markets Policy Partners provide sophisticated financial market analysis that is independent, accessible, and actionable for a broad audience. Learn more at marketspolicy.com.
All right, we're back on the Macrocast. Guys, we saw yesterday afternoon, evening, we finally, I know that these things are moving at like light speed for Washington and for Congress, but I feel like, we keep getting further behind the needs of the economic dislocation that's going on out there. But we finally did get the Senate GOP plan yesterday. It tops $1 trillion, which sounds really big. It's got components of direct payments to individuals, which a lot of us have been pushing for. It's got a really concessionary grant-like, even small business lending in there, and some support for the airline industry and related industries related to the airline industry and transportation, other important sectors. $1 trillion sounds like a lot. I just got to say, I think in the situation that we're looking at, each of the components and the overall number, I think are not going to be enough to answer the call here, either for individuals or for a lot of the companies affected. And I also think, boy, we're just really late. These guys are going to have to go negotiate this with Senate Democrats. They need to negotiate with the House. They need to figure out a way to have votes, which means they have to come together. And we're seeing, some members of Congress with the coronavirus. So how do they get over that hurdle of actually coming in and voting? This is a really complicated situation, and things are moving so fast that I feel like we're not going to be as effective as we need to be.
Yeah, I think every day we delay, the bill just gets bigger.
Yeah, my view. Look, I said this, and I think sometimes people think I'm joking when I say this, but I'm saying, like, look at the number you've got and double it.
Double it. Yep.
Right, just double it, because there's no cost to doubling it, because the demand is the demand. If you're trying to address the demand out there for liquidity, you either have to address it or not address it. If like addressing it not enough isn't really beneficial. And overwhelmingly, these are very concessional, but we are talking about loans. The money is going to be paid back.
That's a really important point. Who cares if it's $5 trillion? And
right.
Who cares if it gets paid over 10 years? It's coming back.
That's right. In the case of payments to individuals, you're talking about payment, a certain amount of spending per month.
Yep.
And you can stop that spending once people start going back to work. There's no point in putting a fixed amount there. Put a giant amount. Again, I keep reminding people, back during the financial crisis in 2008, people remember the ticket price for TARP as $700 billion. And when you hear people talk about it today, they talk about $700 billion all the time. We spent about $320 billion of TARP. We did not spend $700 billion of TARP. We did not use all of the resources available. You might not have to use them. I mean, Hank, people make fun of Hank talking about, if you have got a big bazooka, you might not have to use it, Well, if you got a big bazooka, you may have to shoot it a few times, you may not just have to use it all the time, I think is really what it comes down to.
Tony, I think the numbers back up some of what you're saying. When you think about consumer spending in general being about 40% of GDP, and we see these things down somewhere between 20 and 40%, and we have a $20 trillion GDP is sort of the right way to think about it. If you can easily knock off 10% of GDP in a quarter on an annualized basis, and that gets you to $1 trillion you need to put back into the economy, if not $2. So I think the numbers kind of back up what you're saying when you do the very simple math.
And the part that is driving me nuts with elected officials is, in 2008, banks got greedy and made loans, and then it seeped down to people, and they bought houses that they shouldn't have done, and they blew up the world. The world is being shut down because we have a terrible virus that is killing people. Yeah. Who cares what the number is? No one did anything wrong this time.
Yeah. It was easy to, rightly or wrongly, it was easy to point fingers at, whether it was the financial sector or individual homeowners last time. You could point fingers at them and say, well, some of them are getting what they deserve, and we shouldn't be so generous to them. No one here is getting what they deserve. I mean, government should have done more.
Yes.
Should have been better prepared, should be able to act faster. Like, that's clear. If you want to point fingers at government, that's fine. But it's hard to find an industry that, that should have been prepared for shutting down the economy for 2 months. It's hard to say. You can make a case for airlines maybe, but I don't remember people making predictions that, like, when there is the pandemic scare, people talked about the strain on the healthcare industry, the strain on hospitals, the strain on the amount of doctors and equipment that we need. I don't recall ever hearing anybody say, hey, when there's the pandemic next time, we're going to shut down the economy and tell people to shelter in place for 2 to 3 months. I don't remember those warnings. So, so I think you're right, Brendan. It's everybody is in the tough place here, and we got to address it. By the way, we're starting to see a lot of the private sector estimates on Q1, Q2, Q3 GDP growth. They are frightening. Q2 numbers are in the double digit, 12 to 20% reductions in GDP growth. What people don't seem to understand is that those models are factoring in a fiscal response. That's with a fiscal response.
That's horrifying.
Not without a fiscal response. So, it's really dire. And so I'm troubled that it's Friday and we still don't have something that the big package that is we've seen a small package move through. It had some good pieces in it of paid family leave and those kinds of things that were good. We haven't seen the big fiscal response yet, and the clock is ticking.
I think the market is very much expecting that to come, and if it doesn't, I think there's going to be definitely some trouble. Maybe less on the liquidity side, but you're going to have more of the corporates coming back and saying, as they report earnings, and then starting in basically 10 days from now, they're going to reflect that, and it's going to put much more pressure on the politicians in a worse spot. So I think it's better to do it now. And like I said, we have the numbers to prove out what the private sector GDP estimates are saying. So the debate should be pretty limited because the data exists and is available.
Yeah, I think that's important. So at the end of every episode, we always talk about the week ahead. Next week we get some market data, which doesn't really matter. Unemployment claims does matter, but I think the data we should be paying attention to is the alternative data, like what we talked about right now.
Yeah. So, well, I do think what we are going to see, when we're back next Friday is by far maybe 3 times the largest weekly initial unemployment claims ever recorded. The largest was in October of 1982 at around 700,000 initial claims that week, and this is going to dwarf it by a great amount. So, guys, we're going to have a lot to talk about next week. Matt, really want to thank you for joining us.
Always a pleasure.
John and Brendan, stay safe down in DC.
We will.
And we'll be back on the HPS Macrocast next Friday. Stay safe, everyone.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share. Find more from Hamilton Place Strategies at hamiltonplacestrategies.com and follow Tony Fratto on Twitter @TonyFratto. Learn more about John Fagan, Brendan Walsh, and the work they do at Markets Policy Partners by visiting marketspolicy.com.